Well, welcome back. Time now for the Word on Wall Street. Top investors watching your money. Joining us now is Payne Capital Management President Ryan Payne. Also with us is Kevin Kelly this morning. Ryan, good to see you. Thank you for joining the conversation.
Great to be here, Maria.
And we got a market this morning that seems nervous ahead of the Fed meeting, of course. Let's take a look at futures down across the board, fractional moves. But, of course, we are on the Fed Day. Federal Reserve's rate decision is happening today at 2 p.m. Eastern. This is the final big event of the year for markets. Yields are higher this morning, and I'm scratching my head to understand why. The yield on the 10-year is up almost 2 basis points right now, sitting at 4.20%, even though you got 90% of investors expecting that the Fed is going to cut rates today. Your thoughts?
Yeah, well, first off, right, I don't think Jay Powell ever surprises. The only time he surprised when he was at a Grateful Dead concert in 2023 or spotted there. So I think he's definitely going to cut rates, tomorrow now, or today rather. But I think what to remember is longer-term rates are really driven by inflation expectations, not what the Fed's doing short term. And if I was talking to you on this set 3 years ago in December, guess where the rate would be for the 10-year? 4.2%. So even though it's come up a little bit, down a little bit, we've kind of been in the same place now for the last 3 years of the 10-year. And I would argue right now, inflation expectations are pretty much in check. And if you look at the dollar right now, it's weakened this year, but it's started to stabilize, which is, protecting against more inflation for imports. And I always mention this, but oil prices have just plummeted, and that's a huge inflationary input, and that's very disinflationary. So that's why you're starting to see. So the 10-year and the short-term rates don't exactly move together.
So what's your take on all this worry then about inflation? If you're saying some of these key issues are actually down.
I think that's been the worry all year. Economists have been telling us that we're going to have inflation, we're going to see inflation, tariff-related inflation, which longer term may be true, but for the foreseeable future, and I think the bond market's telling you that, the fact that the 10-year is only at 4.2% is expectations, or at least the market's expectations, are in check right now.
I think one of the big policy twists of the year has been the fact that the bond market seems to want tariffs in place. And I want to talk about this because today is the last day for the Supreme Court arguments in 2025. Which suggests any year-end decisions about IEEPA, which is SCOTUS looking at President Trump's emergency use of tariff, that decision is imminent. We're going to get that any second, any moment in the next couple of days. The court returns for oral arguments on January 12th. But the fact that today is the last day means that's it. We're about to know. What do you think?
Yeah, well, the federal government does need the tariff revenue, and we've even seen the Biden administration kept all the tariff revenue that they got from the previous Trump administration. Right? And even though they lambasted tariffs. But I think it's important to note that if you're worried about inflation, the best place to be is in the markets, right? The stock market is probably one of the best places to be, especially because a lot of companies, and Jamie Dimon even said it to you, and we've seen it, that, they're reinvesting, right? And so that's good because they're reinvesting at great rates, and earnings are expected to do very well in the first quarter of starting January, end of January, we'll see next earnings season. They're expected to do well. So we're after today's policy decision and after Powell gets done talking, it's a great time to be in the market because we have the seasonality effect. It's called the Santa Claus rally, and getting in now ahead of earnings next quarters is a pretty good place to be.
Yeah, for sure. And this is, like I've been saying, the last or the final big event for markets, the Fed meeting of December. But I have to say that the other major event is going to be this SCOTUS decision on the president's tariffs. Now, one of the big questions is the president going to have to pay money back? Because he's raised about $200 billion in tariffs. I spoke to the president about it just a couple of months ago. Watch this.
Yeah.
What is your backup plan should the Supreme Court decision go against you on the tariffs and the emergency
Well, I'll have to figure something out. I don't want to even think about it. We're doing so well to think about it. If that happened, we'd have to pay back money. So if anything would happen with that, that would mean they're allowed to use tariffs and we're not. If they took away, this is national security, if they took away tariffs, then they've taken away our national security.
There are a certain number of statutes that the president could use. 122 is one, 338, 301, they talk about a lot. So they're going to try to recreate tariff revenue with those, I suspect. What do you think?
Well, first off, getting an IRS refund is impossible in my whole life. So I think they're going to find a way. I mean, it's very hard pressed to see $200 billion worth of revenue that the government's taken in going back to different countries, being paid paid back. Also, I think what's huge about this, and this goes back to the bond market and why the bond market's been in check, especially on those longer-term yields, is the fact that if we continue to keep these tariffs in place, which are like 12% this year, that's like $3 to $4 trillion over the next decade. That's a real dent in our massive, massive deficit. And that's the only real revenue we've seen that could actually start to pay that down. So I think that's very critical, too, for interest rates.
Yeah, I just wanted to point out that today is the last day for the Supreme Court arguments for the year. So it's important to understand that we're going to get this decision soon. All right, we got to talk about the deal of the week. Could be the deal of the year. Netflix is now facing a consumer class action lawsuit seeking to block its planned takeover of Warner Brothers. The suit claims that this deal would reduce competition in the U.S. streaming market. Netflix is calling the lawsuit meritless, saying that it's an attempt to capitalize on the attention around the deal. And, of course, there's a lot of attention around the deal because Paramount launched a hostile bid to break up Netflix and Warner and take over Warner. We don't know where this is going, but, Kevin, Netflix's bid is facing antitrust scrutiny in Washington, that we know, because the president questioned whether or not, as a streaming company, these two would be too big, Netflix and Warner together.
Yeah, and either way, if Paramount wins, Paramount could become too big. And so what's interesting to note here is that this is going to be battled out. Regardless, Warner Brothers is going to be taken out. They weren't doing very well before this. And then once this started happening, you saw a bidding war because those are key assets. They're very, very valuable. And so it's going to be interesting if the government's going to pick a winner or loser here, right? That's what I'm worried about.
Well, I mean, I know we've been looking at prediction markets a lot, right?
Yes.
Was it Polymarket or CalSheet? The prediction markets have 90% chance that Paramount wins this.
I think so because there are antitrust issues here. Think about it. There's only really 4 providers now. I know personally as a consumer, I have Netflix, I have Disney, which is Hulu, I have Prime, which is Amazon, right? And then I actually have an HBO subscription as well, which is Warner. So if that goes under Netflix, your options actually shrink down to 3 providers. I think that's a really big problem. And it doesn't hurt that the backer for Paramount happens to be Jared Kushner, who is Trump's son-in-law. Just saying. Yeah. But I think bottom line is, I think that's.
He's friendly with the Ellisons, that's for sure.
Yeah, the Ellisons are actually. So the Ellison family office is actually going to back the Paramount offer, right? Yeah. So they're coming in with cash from the Ellison family office. Also, it's an all-cash deal. So I think that's why it may be more advantageous for Warner Brothers shareholders because they're getting all cash as opposed to cash in stock.
Yeah, I mean, Trump's personal involvement here could move this in one direction. What did you make about the move in JPMorgan yesterday? JPMorgan stock down better than 4% because at the Goldman Sachs conference, the bank told investors it's planning to increase expenses to $105 billion next year. That's more than what Wall Street was expecting. It's a 10% increase from the year's this year at $96 billion in expenses. Consumer chief Marianne Lake said that the bank is boosting spending on compensation, marketing, and strategic investments, from opening new branches to expansions in AI, Ryan.
Yeah. Well, first off, the stock's up 28% this year, even with that sell-off yesterday. It's had a phenomenal year. If you look at their banking revenues, up 20%. If you look at their trading revenues, up 20%. So, yes, you are going to spend more money when your bank's doing well. It's going to go to their advisors. It's getting paid on AI infrastructure. And I think you're going to see this with most companies right now. CapEx spending is going to go up because you have to spend money to make money. So I think that's actually going to be a theme amongst most companies right now as they're trying to compete, especially in the AI landscape. So, look, if you look at JPMorgan next year, they're going to do $190 billion in revenue, so $105 billion in expenses. Not the end of the world.
I want to see this from companies, actually, because next year they're going to get 100% depreciation expense that they can take to offset a lot of their big deal, which is great for earnings. So hearing this, it's like, I applaud it. Yes, everybody, increase your expenses, start building outlets, getting manufacturing back here, and that's what a lot of companies are doing.
All right, we will leave it there. Ryan, great to see you.
Thanks, Maria.
Thank you so much for joining us. Ryan Payne, Kevin, you'll be with us all morning. We're so grateful for that.